We got some new data for Canada's economy. Inflation numbers slowing to 1.8% on a year-over-year basis in December. Now, the sales tax holiday that we saw at the end of last year carried into this year did weigh on headline inflation. That could even actually be felt in the January numbers as well. So if you're the Bank of Canada and you have an upcoming interest rate decision, what should you be looking at? An inflation number like this one, impacted in part by the sales tax holiday? Or should you also be looking at what's happening with our loonie and the tariff uncertainty? Let's bring in a former economist from the Bank of Canada, who currently serves as the chief economist at Alberta Central, Charles St-Arnaud. Charles, great to have you back with us. Give us your take on what the inflation picture truly looks like in this country right now, first off.
Yeah, as you mentioned, it's clear that the GST holiday had a big impact on headline inflation. So headline inflation came in at 1.8%. But when we look at measures excluding taxes, it's actually increasing. It actually accelerated to 2.2%, so slightly higher. So it's clear that without the tax holiday, inflation would have accelerated in the country.
And so I guess, as I said, if you're the Bank of Canada and you have to be thinking about your plans with interest rates going forward, we're basically a week away. It sounds like most people at this point are expecting that there's a reasonable chance the Bank of Canada would continue cutting interest rates, maybe 25 basis points. They don't want to rattle the markets too much by shifting based on all the other stuff that's happening right now. But what do you think their playbook's going to look like?
Yeah, I think at this point they're looking through the impact of the tax. It's a temporary effect, so they will look at what's going on in inflation, excluding the impact of the GST holiday. So there are some small upside in the inflationary pressure in recent months. We're seeing, like I said, inflation excluding taxes accelerated slightly in December, still in line with the Bank of Canada target, which is to keep inflation between 1% and 3%, but also under the hood, when we look at what I call the momentum, so the change in prices over the past 3 months at an annualized rate, when you look at the core section, we're again above 3%. So that could start to rise some, or to ring some alarm bell for the Bank of Canada, where they'll need to be a bit more focused on that. But on the flip side, when we look at what has been their main focus in recent months, is that it's really the concern on the downside risk to growth. We know growth is going to decelerate in 2025 because of weaker demographic. We also have the threats from the tariff, which will most likely be a drag on the economy given the uncertainty. So it's how they balance that. And I think at this point, they're probably looking more at the let's provide some stimulus to prevent the downside risk from happening, or at least soften some of that downside risk.
Well, and then I want to throw something else into the mix, which is our currency, which, as you know, we've generally seen malaise for the loonie as it trades against the greenback. And as we look at it right now, and our Bloomberg colleagues have a story out about the fact that we're basically at the lowest levels since the pandemic in March of 2020. And I've asked the Bank of Canada governor in the past, not the recent past, but in the past, about what he thinks about a weaker dollar and an interest rate cutting environment, and do we import inflation from that? And I think early in the rate cutting cycle, he was discounting that. How does the loonie factor into their decisions going forward?
Yeah, it matters a bit. I think the weakness we saw in the currency might explain what we're seeing in terms of some upside pressure on inflation, especially in momentum. We might be starting to see some of that pass through from the weaker currency and inflation. The question at this point is, what is more concerning for the Bank of Canada? Some impact from a weaker currency, which, yes, have depreciated a lot over the past 6 months, but have been relatively stable at a weak level in recent weeks, and we haven't seen the continuous depreciation? Or are they more concerned by the downside risk, which would be more deflationary, especially if we were to get tariffs or other shock on the economy? So that's where I think they'll continue to focus a bit more on the on cutting interest rates rather than being too much concerned by the inflationary impact of the weaker currency.
All right. Before I let you go, it's the impossible question, but we are entering into the volatile reality that is a Trump presidency, and nobody knew if there would be tariffs on Canada as of day one. Then on day one, there was a reference to a possible start date for tariffs on February 1st. Even our prime minister today said, this is part of the strategy of negotiation for the new president. As an economist, how do you chart this out for Canada's economy? Because 25% tariffs would not be a good thing for our economy.
Yeah. Well, at this point, we have to treat it as a risk. We have to look at what will be the implication and what should we be put in place if they were to be put in place and if they were to be in effect. But at this time, it's more the increased uncertainty that's actually creating a relatively negative economic environment for businesses and consumers to actually take decision. And that will have a drag on growth in the first quarter of this year just because of that.